welcome to the Monday Futures Market Outlook for August 15th, 2011. This is Patrick Sresna. For those of you that have not had the opportunity to try the Minisource.com's trading room, 5-day complimentary memberships are available. As always, we'll start off with a weekly chart of the S&P 500 going back 3 decades, and we plot an 80-week moving average on there. It does a very good job to depict the bull and bear market cycles that we've gone through. We were looking for all supports to hold above 1200 on the S&P in order for us to remain relatively bullish in these zones, and essentially we had rather now an official breakdown that went as low as the 1077 on the S&P futures, essentially giving a very clean and distinct bearish signal on that move. Question is this signal here just a short-term noise event, or is there a bigger bear market beginning from this signal? Just to review our key intermarket observations, the last 2 weeks have dynamically changed the landscape of the market, and the crash has basically done a large amount of technical damage to the overall marketplace. Now that we've closed below that 80-week moving average since 2009, in the past it has signaled the beginning of prolonged bear markets. Overall, I would think that what will be the real tell will be to the degree of which this rally that started late last week manages to go. If we have an S&P 500, like you'll see on the daily charts, that fails in the mid-1200s, it would certainly be a genuine risk that there's going to be another breakdown move. In regards to US dollar, it continues to chop in a sideways range, particularly driven by the fact that the euro is in just as much peril as the US dollar. And so the two major currencies that play, and the euro being such a major component of the US dollar index, doesn't allow the index to actually make any significant moves. This is forcing commodities and bonds to really move on their own in terms of intermarket analysis. Oil is particularly the most bearish commodity out there right now. While copper has continued to show weakness, in the oil weakness is really where we're seeing a lot of the big pushes. In regards to bonds, the 30-year Treasury bonds last week were just a few points shy of the 2008 all-time high. And the question is, will those 30-year Treasury bonds reach historical lows in the yields? And that's going to be a very interesting thing to watch over the next short period. There's only so low that the yields will be able to go. So at some juncture, we do expect 30-year Treasury bonds to hit a major high. But certainly if there's one more leg lower in this market decline, the bonds still have the chance to continue to make one more push higher. When we take a look at that S&P 500 on the daily charts, you can see that drop brought in that bottom down just below the 1080 level on the daily charts. Really at this stage, that's now going to be our new focal point on the downside, and we're now seeing a rally that, when I mark off in this blue box, we anticipate there to be a rally creating some sort of a wedge on the upside that could go as high as the 1210 to 1250, 1260 area on the upside. We do believe that there's a genuine risk that this market will fail somewhere within this blue box and begin one more retest of those market lows at minimum. It doesn't necessarily have to be a breakdown to new lows. Of course, we could see another push that maybe even tests the flash crash market sell-off lows around the 1000 area. But before we start making any major bearish kind of forecasts on the downside, we first want to see where and how far this rally goes. It's quite possible that this rally lasts even a week or two in duration. So for the next two recordings, we may just continue to see that S&P inching higher, but it will be a failure in this 1210 to 1250 area that would be very concerning for what could still be even another 200 S&P points lower from wherever those highs come in. Next year, I want to take a look at that U.S. dollar index, and like we were talking about, it continues to be stuck in this sideways channel, chopping back and forth in this range, and there's some short-term bearishness still where the U.S. dollar can very easily make that move down below 74. But it would, but if we have any legitimate breakdowns of the U.S. dollar, we could still see a move down to the 71 or even 70 area on the downside of the dollar index, which would certainly kind of cause everything to kind of take a pause in terms of the selling and commodities in the markets. But so long as the dollar remains sideways, range bound, really anything can happen in the broader base. So when we take a look at copper futures and see what's happened, copper basically for the last 2 weeks has shown some significant weakness now, consolidating down to near the lows of May around that 380, 390 level. We are again looking for the similar pattern of it kind of creating a retracing flag. We could see even copper work up to 410, 420, even 430 on the upside, but we would fully expect that wedge to break down and force copper to come back down and retest the lows. If we see a rally, let's say to 420, and then it rolls back down, we probably could see 360, so roughly where the lows came in back in November, or even potentially the August and September highs somewhere in the 340 to 350 area. Those are all levels where copper could test on the downside if we have a failed rally. Next year, I want to take a look at gold futures, and gold has exceeded our 1750 high, particularly being driven by an extended move driven by the fear-mongering in the broader markets. Gold is long overdue for a flag or a wedge consolidation on the downside, but nor do we believe that that will be an end of the trend, though. Really, at this stage, we could see even another $90 on the downside of gold as we see it come down to 1650. And if there's a real catalyst, there could be even a retest of the 1560, 1580 focal point below, but I wouldn't bank on that at this juncture. Really, at this stage, just looking for some further weakness, maybe another $40, $50, $60 on the downside of gold over a couple of weeks as it finds a solid base to unwind the overbought state that it was in, and then we should see gold make another attempt to retest those highs, if not even make higher highs at some later point a couple weeks from now. Next year, I want to take a look at crude oil, and crude oil finished a measured move lower down to even hitting around the $76 on an intraday overnight basis. It was really the European session where that drop occurred, and we've now seen that bounce higher. And this is the same story as everything else, where there's a retracement zone that lies up in this 89 to 93 area, sort of in the 90, 92 focal point lies in the middle of that zone. And I wouldn't be surprised to see crude oil still even strengthen another $3-4 on the upside over the next week or two. But as this could form into just a flagging formation on the upside, that over a 1 week rally can roll over again. So remain relatively negative on crude oil until we see a solid bottoming formation. Maybe the next really good buying opportunity crude oil may lie all the way in mid to late September, if not all the way out in October. Finally, I want to take a look at that 30-year Treasury bond in that 40.42 focal point up above marks the high on the continuous contract of where the highs came in the 2008-2009 rally that saw historical lows on the yields on the 30-year Treasury bond. At this juncture, we're seeing a little bit of consolidation. There is room for Treasury bonds to certainly even pull back here down to even the 134, 132, 130 area on the downside. But so long as the turmoil story in the U.S. economy and the global economy continues to occur, Treasury bonds will probably only consolidate downwards to only come back and retest the highs at some juncture. So make sure that if you're trying to catch the downside swing on these Treasury bonds, you're taking your profits into this weakness. That was your Monday Futures Market Outlook. Thank you for joining me.